On October 19, 1987, the world watched in horror as financial markets experienced a meltdown of historic proportions. In just a matter of hours, a staggering $1 trillion in value simply vanished. Panic rocketed from Wall Street to trading floors in Europe and Asia. Investors stared at their screens in disbelief as stock prices plummeted without any apparent reason. This day would forever be known as Black Monday. What made this crash so terrifying? Unlike the great crashes of the past, Black Monday wasn't triggered by a war, a recession, or a banking collapse. It came out of the blue, a perfect storm of fear, new technology, and a financial system that was far more fragile than anyone realized. So, what really happened on that fateful day? Why did markets fall so hard, so fast? And how did this single event forever change the world of finance? Let's dive in. To truly grasp the shock of Black Monday, we need to rewind a little. The first half of the 1980s was an amazing time for the US economy. Inflation was finally under control, interest rates were coming down, and companies were making record profits. This created the perfect environment for a massive stock market boom. Between 1982 and 1987, the Dow Jones Industrial Average soared, climbing over 250%. Confidence was at an all-time high. Many investors genuinely believed the good times would never end, that the market could only go up. But beneath this glittering surface, the cracks were already starting to show. Stock prices were getting dangerously disconnected from the actual value of the companies they represented. Valuations were stretched thin, making the entire market incredibly sensitive to any hint of bad news. At the same time, troubling signs were emerging on the economic front. The US was running a huge trade deficit. Interest rates were starting to creep back up, and major world economies were arguing over currency values. Despite all these red flags, the party on Wall Street continued. Optimism was the drug of choice, and almost no one saw the cliff that was just ahead. One of the most critical, yet misunderstood, elements behind the crash was a new financial tool called program trading. Essentially, this involved using computer algorithms to automatically buy or sell enormous blocks of stocks based on market movements. A particularly popular strategy was known as portfolio insurance. It was designed to be a safety net. The idea was simple. If the market started to fall, the computers would automatically sell stocks or stock futures to limit an investor's losses. In theory, it was a brilliant way to protect against a downturn. In reality, it became the fuel for an inferno. When the market began to wobble in the days leading up to October 19th, these portfolio insurance programs kicked in, just as they were designed to. They started selling massive quantities of stock, all at the same time. This huge wave of selling pushed prices down further, which in turn triggered even more automated selling from other programs. It created a vicious, self-reinforcing cycle. Human traders on the floor were completely overwhelmed. They simply couldn't keep up with the speed and scale of the computers. As the first wave of fear hit, buyers vanished. Liquidity evaporated. The market was now in a terrifying freefall, feeding on itself. On the morning of Monday, October 19, 1987, the selling pressure became unstoppable. When the opening bell rang at the New York Stock Exchange, the air was already thick with panic. A tidal wave of sell orders flooded the market, but there was almost nobody left to buy them. Prices didn't just decline, they collapsed. Within minutes, the screens were a sea of red. By the time the closing bell mercifully rang, the Dow Jones Industrial Average had plunged 508 points. That was a drop of 20.6% in a single day. To this day, it remains the largest one-day percentage loss in the Dow's entire history. And this wasn't just an American problem. The crash went global, and it was brutal. The UK's FTSE index lost over 26% in just 2 days. Hong Kong's market was even worse, crashing more than 45% in 1 week. Markets in Australia, Canada, and across Europe all suffered catastrophic losses. In total, over $1 trillion of wealth was wiped out in a few short hours. Investors were completely stunned. There was no single piece of news, no declaration of war, no natural disaster to blame. Fear itself had become the event. In the immediate aftermath, there was a very real concern that the entire global financial system was on the verge of collapse. Banks were terrified they would become insolvent as their borrowers faced ruin. The public feared a return to the Great Depression. Confidence in the markets wasn't just shaken, it was shattered. But just when it seemed like a complete meltdown was inevitable, decisive action from central banks pulled the world back from the brink. The very next day, The U.S. Federal Reserve, led by its new chairman, Alan Greenspan, issued a short but powerful statement. The Fed declared it was ready to provide unlimited liquidity to support the financial system and ensure markets could continue to function. This promise was the lifeline everyone needed. It gave banks the confidence to keep lending. The panic began to subside, and slowly, markets stabilized. Within a few days, stocks even began to recover some of their losses. While the psychological scars were deep, the world economy managed to avoid the deep recession that so many had feared. Black Monday became a brutal, but necessary, wake-up call that permanently changed how financial markets operate. In the years that followed, regulators introduced new safety mechanisms called circuit breakers. These are automatic triggers that temporarily halt all trading during moments of extreme panic, giving everyone a moment to breathe and preventing a downward spiral from feeding on itself. The crash also forced a complete re-evaluation of risk. The hidden dangers of automated trading, using too much borrowed money, and the power of herd behavior were now painfully obvious to everyone. But perhaps the most enduring lesson of Black Monday is a simple one. Markets are not purely rational. Human emotion, especially fear, can overwhelm any spreadsheet or financial model. This is even more true today, when technology can amplify that fear at the speed of light. More than 3 decades later, the ghost of Black Monday still haunts Wall Street. It serves as a constant, powerful reminder of just how quickly confidence can evaporate and how fragile our financial systems can be when panic takes control. Black Monday wasn't just another stock market crash. It was a true turning point in modern financial history. It reshaped regulation, forced innovation in risk management, then gave us a profound and costly lesson about the psychology of markets. And in today's world of high-frequency trading and algorithm-driven strategies, those lessons are more relevant than ever. Thanks for watching. If you found this look at financial history interesting, be sure to like this video and subscribe for more. See you next time.